All right, let's go ahead and get started, class. First thing, we talked last time about a Blackboard issue with seeing the quizzes. I made some progress on it. Danelle, did you make any progress on it? Yeah, I called that number that I gave you, and I got it went to voicemail and then it said the mailbox is full. So sorry about that. But I got two important pieces of information. One, apparently you can see the past quizzes according to Venetia if you just click on the grade you got for the past quiz. So you go into My Grades, and then you click on the grade you got, and it'll take you to all the past, all the questions, and the right answers, wrong answers there. So that should solve the problem, but in addition to that, I talked to a few people on Mercy Online, and I made another addition. And I made a quick change. Yeah, this is the first day. And I made a change that, I don't know if it made any difference or not, but anyway, that's the answer to that. Does that make sense? All right, so we're going to start today with capital budgeting. Budgeting for big capital expenditures. We've talked in past sessions about determining value for some sort of corporation, some sort of project, some sort of personal investment. We're looking essentially as if you are an analyst in the business development department of maybe a company, or maybe you're an investment bank that works with people like this, and you're deciding how you might spend money on big projects, whether or not you should invest in these big projects. We will use a number of metrics to determine whether a project is a good project or a bad project. We've talked in the past about just the net present, or the present value aspect. We've added up all the cash flows coming in, and we subtracted off the initial cost. And I asked you questions such as, should you invest in the project with this cash flow? And essentially what we were doing is this first one, which is net present value. We didn't call it net present value. Net present value is just adding up all the cash flows and taking the net value. We'll go over some other ones. A close second, this net present value is probably the most popular metric for capital budgeting. A close second is IRR, which is internal rate of return. And we'll expand on these. You don't need to take notes or anything now. I'm just giving you a quick overview. There is a slight modification to internal rate of return that analysts use because IRR misses a small piece of the sort of accounting for certain cash flows. So these two, net present value and IRR, most common, and some smart analysts use the modification for IRR. These others are less common, but we'll go over them just so you have more tools in your toolbox of determining whether or not you should take this project or not. Profitability index, payback, discounted payback, and lastly we'll look at unequal lives. Suppose you're looking at one project that is 2 years, you're looking at another project that is 4 years. That's an apples to oranges comparison. How can we make that an apples to apples comparison? And we'll go over a way to do that. This may look familiar to you. Instead of looking at value here, we've changed net present value, which is the most common way we'll look at these cash flows, but everything else is similar. We will determine cash flows of a certain project. Maybe we'll pick through the financial statements like we learned how to do in class 2. Maybe you'll talk to the guy in the back room of some shady bar who's going to tell you you'll get this much cash and this much cash on year 2, 3, and 4, and you'll determine the amount of risk based on those estimates. You'll do your time value of money calculations, the net aspect of it, because you're subtracting off your initial investment, and you will make decisions about the discount rate the same way we've talked about before. What's the market risk aversion? What are the interest rates? If we wanted to borrow money for this project, how much would it cost? What is the risk of this project? What is the debt equity finance we're using? Are we using a bunch of bank loans? Are we using some bank loans and some investors that are going to be breathing down our necks saying we must have this much return? Everything is the same. We've talked about all quarter. We're just plugging in something such as net present value for our final calculation. So capital budgeting, I think I mentioned longer term projects. investments in a company in a different country, investments in the infrastructure your company might need to produce a new project or produce a new product, excuse me. Long-term expenditures, important to firm's future. Steps. What are the steps we would take in capital budgeting? Well, let me throw out some steps that your textbook suggests. First, we estimate the cash flows. We hear about this project. We dig through some financial statements. We, as I mentioned, talk to this guy who's got ideas. We take an estimate of those cash flows. We think about the evaluation method we would use, and I listed a number. Net present value, IRR being the most common. We'll make some decision about which is more important to us and which we're going to give the most value. We do our calculations, and then we decide, does this meet our standard or does it not? I think I mentioned some sort of the categories. These projects you might be evaluating could fall into replacing things, reducing costs, expanding, traction decisions. Maybe you're doing a smaller firm somewhere else that's going to save you money. Safety in our environmental projects. Mergers. You're going to merge with this company. Think about whether or not it makes business sense. And then you as the financial analyst would do these evaluation metrics to think about how much you might pay for this company. Other stuff. Quick note about independent versus mutually exclusive projects. Suppose you're looking at two projects and they are independent if cash flows of one are unaffected by the acceptance of the other. So say you're looking at going and building a factory in China, you're also looking at building a factory in India. If you build the factory in China, then the business development, brain power, the folks you need to engineer a project are going to be focused on China, and they're not going to be able to focus on India in the same way. So it might not be as successful because you took one project. It's going to affect the cash flows of the other. If that's not the case, then we call them independent. But if that is the case, if the cash flows of one can be adversely affected by the acceptance of the other, we call them mutually exclusive. Questions on that? Okay. Let's take a look at cash flows for a couple of projects, and then we will stick our evaluation methods on them. Two projects. One we'll call L, the other we'll call S. Suppose both of them require a $100 initial investment. Suppose through our analysis we've determined the proper discount rate is 10% for both of them. Cash flows for L are $10 in year 1, $60 in year 2, $80 in year 3. Cash flows for S, 70, 50, 20. Now let me ask you right off the bat, anything you notice about these cash flows, or how is one different than the other? Anything strike you? This one's increasing. Okay. This one is decreasing. Great. Good insight. How about the timing of these cash flows? I guess one do we get our money back sooner versus later? Which one? S is sooner? Yeah, so S we get a big chunk of the money sooner. L we get a big chunk of the money later. So that's one thing that we'll keep in mind as we evaluate these projects. First way we might want to look at this is our net present value calculation, which is similar to what we've been doing all along. We essentially add up all the different cash flows. This fancy sign just means the sum of all the cash flows starting with t equals 0, going all the way to where t equals n, however many years you have. This is just your time value of money calculation. The cash flow in that period divided by 1 plus the interest rate raised to the time period. You'll add all those up, you'll determine the net. For example, If we were to look at L, and I wish I had left this blank for you to work out, but I didn't, so I will go through it a little bit faster, and then I'm going to open up Excel, and we're going to talk about how you might calculate this on Excel. That'll be the slower, more exciting part of class today. But for now, I'll just run through it. So you make an initial investment of $100 at the beginning of Project L. A year later, you get $10, and that is worth, in today's terms, after you divide that by 1 plus the interest rate of 10% raised to the first power, $9.09. Same thing in year 2. At $60 you get, in present value terms, worth $49.59. Year 3, the $80 you're going to get then is worth $60.11. You add that all up, you get a net present value of $18.79. Make sense? If you were to do the same thing with Project S, you would get a net present value of $19.98. So, looking at those two figures, which project do we like more? Project L or Project S? S. We like S more because there's higher net present value. So, if we had to choose one of them, we would choose Project S. Now, suppose these are independent projects. We don't necessarily have to choose one of them. We could choose both if we wanted to. Do you think we would base just on the net present value calculations we do? Or just have done? Would we take both of them? Would we take one of them? Would we take neither of them? Which of these two projects, what would we say to each of them? Yes, no, maybe? Ananya? What do you think?
Maybe both of them.
Both of them? You like both of them? Okay. Anyone else want to weigh in? So, Project L, it costs us $100 to invest. We get back, I guess, a total of 10 plus 60, 70, a total of 150 we're getting back. And in present value terms, after we've discounted that for time value of money and the risk associated with this project, we not only get our $100 back, but in present value terms, we get an extra $19 back. So yeah, we like this project. It meets our demands. The people we're going to have to borrow money from, we're going to give them all their money back. The investors who invest in our company, we're going to appreciate the value of their investment in an amount that is appropriate for them. We're going to do all that, and we're going to have $18.79 left over, profit. So we like these projects. We like positive NPV. And we like Project S a little bit more. We like them both. If we could take both of them, we could take both of them. If they were what we'll call mutually exclusive, meaning we have to concentrate on one at a time or they adversely affect each other for some reason, then we take the higher one, we take Project S. Any questions? Okay, net present value inflows minus the cost. There's net gain in wealth, so we accept if the NPV is greater than 0. Choose between mutually exclusive projects, choose the higher NPV. Accept both if they're mutually exclusive. We talked about how we liked S more. Now, NPV, let's note this third bullet point. NPV is dependent on the cost of capital. Now, the cost of capital is that discount rate we used of 10%. So suppose we decided that's not accurate. That discount rate should be 12%. What would happen to the NPV, first of all? Decrease, yes. So a higher discount rate decreases the cash flow, the present value of the cash flow, and decreases the net present value. So, if we were to choose a higher cost of capital, we may get to a point where we'd say there's a negative NPV. It's -6. It's to a point where we would not accept it. So a couple things on that. One, of course, you try as best you can to choose the right discount rate, but you're not God. You're not going to know the perfect discount rate to use all the time. So understand that it's something of an estimate. Understand that we'll use other metrics to take a holistic look at this particular project and whether or not we want to invest. And of course, you're going to use some common sense. Of course, you may get it wrong, like so many people did in 2007, estimating whether projects were worth it or not worth it, whether or not they should make the loan, not make the loan, whether or not you should invest in this real estate, not invest in this real estate. Sometimes people get it wrong. Now you have a little bit of understanding some of the ways they use to make those decisions. But for now, just remember that NPV is dependent on the cost of capital. That 10% figure we used, that made a difference in whether or not we accepted or rejected this project. Second metric, second way of evaluating cash flows for capital expenditures is IRR, which is internal rate of return. What IRR does is it finds essentially a discount rate for us. It looks at the cash flows. You have some cost in week 1, the beginning of the project, and you have cash flows in year 1, year 2, year 3. IRR finds the discount rate that would make the present value, the net present value, 0. Does that make sense? The discount rate that would make the net present value 0. It forces the present value of inflows to equal the cost, the same as forcing NPV to be 0. So, if we look at NPV, for calculating NPV, I showed you this formula. The sum of all the cash flows starting at time equals 0 all the way to time equals n. Use your present value of cash to discount that. Solve for NPV. IRR is using that same equation, but a little differently. It's saying, let's assume, or not assume, let's make NPV 0 and determine what discount rate we would need to use for that project to have a 0 NPV. Does that make sense? Now, it's hard to do this calculation by hand. A couple of ways you can do it. If you have a finance calculator, you can use your finance calculator to calculate it. I find Excel is the easiest way to do this. Speaking of Excel, I think I will go ahead and turn to Excel after I get done explaining IRR. So if we were to use Excel or use a finance calculator to determine the IRR for Project L, it would be 18.13%. If we were to use the IRR or the Excel or finance calculator to determine the IRR for S, it would be 23.56%. So let's think about that intuition for a minute. First question, which of these projects, just based on this calculation, do we like more? All right, we got one vote for Project L, one vote for Project S. Who said S? Oh, we got 2 votes for Project S. All right, why do you like Project S more, Jane?
Because the return, the rate of the return is higher than
The rate of return. Okay, yeah, I guess that's a good way to say it. So what IRR is doing is it's telling us how high that discount rate would need to be to force down those cash flows to zero. And the higher it is, the more cushion we have, I suppose. And I understand it can be confusing, where 1 minute we're looking at a high discount rate being decreasing the value, and now we're looking at this high RRR showing us that there's more value. But we just have to think it through. So the higher discount rate essentially means that the math needs to work harder. You need to put that much, I guess, discounting value into your discount rate. You need to penalize the cash flows more. There needs to be more risk, higher interest rates before the value of the project gets down to zero. So IRR, we like higher IRRs. If we had to choose between these projects, we would say we want project S. If these were independent projects, we would take both of them. Because as long as they have an IRR that is higher than our discount rate, then we say we like that project. So our discount rate we were using in the previous example is 10%. But the IRRs for these two projects, one was 18, the other was 23. So not only does it beat our required rate of return, it has a significant cushion for what our demands would be. So if the IRR is greater than our discount rate, it's good, take it. It's going to be greater than cost and some return left over. Example, project added extra value. If they're independent, we take them both. If they're mutually exclusive, we take S. Now, IRR is not dependent on the cost of capital. So we decided our cost of capital was 10%, but IRR did not use that number to calculate the metric itself. We used that number to compare when we said IRR is higher than 10%. So it is not dependent on the cost of capital that way. So NPV is dependent on the cost of capital. IRR is not dependent on the cost of capital. But it does play into our decision, because ultimately we're going to say our cost of capital is 10% and IRR has to be higher than that metric. Let me turn to some Excel calculations before we move on. What is your experience and such with Excel? Do you all use Excel a lot, a little, never? Little, tiny bit? Anyone use Excel a lot? Anyone ever done some sort of cash flow analysis like this? All right. So this Excel sheet I've posted on Blackboard, I think under Tools and Examples. You can pull it up, look through it, pick through it, work through it, try to reproduce it yourself. You will probably want to do some of these types of calculations in preparation for your quiz that will cover the material for this week. You'll have questions just like this. It'll say, all right, the cash flow is this, this, this. Should we accept the project? Or what is the NPV? What is the IRR? So I have got all these down, and I'm just going to work through it really quickly and have you watch me reproduce this as if I were an investment banker up late at night in my cubicle trying to work out these details. So someone comes to me and says, hey, we've got this project. It's a 3-year investment. here's the cash it's going to cost us. Here are the cash flows that we're going to receive. Tell me the IRR. Tell me the NPV. I'm like, okay, I'm on it. Let me open up Excel. Let me start by putting in the years. We've got year 0. Now we've got year 1. We've got year 2. We've got year 3. Okay, boom. Now, let's look at the cash flow figures. Year 1, we're getting negative. We're going to pay negative. Whatever. Year 1. Year 1, it's going to cost us $100. Year 2, we're going to get 10. Year 1, we're going to get year 0, we're going to cost us $100. Year 1, we're going to get 10. Year 2, we're going to get 60. Year 3, we're going to get 80. Boom, got that. Now I need to know, first of all, our discount rate. Suppose my boss tells me, all right, the discount rate we're going to use is 10% because we're going to take half in loans from so-and-so. The bank's going to charge us 8%, and then we're going to use the rest in equity, and our equity investors demand 12%, or maybe it might be a little higher because we get a discount for the, whatever. We figure out the discount rate of 10%. So we need R in one of these Excels. Put a 0.1 here. And to make it clear, you can, one function you use a lot in Excel is format cells. So you'll just right click and format cells. Say we want this one to be a percentage. We want to see a couple decimal places. So our rate of return is 10%. So I want to find the present values of each of these. So does anyone know what buttons I might push in Excel? Anybody want to talk me through this?
Formulas?
Yes, formulas. So for the $100, well, first of all, what is the what's the formula? We're going to be, just what's the math? What would you do if you put it on in your calculator? Get my marker in case we need it. Let's look at that first year at $10. Like how do we calculate the present value of that $10? This $10 here, or $10 million. Use our, let's see, if this doesn't work here, I'll try a little thing on the side. We use the present value, right, the future value. Is our future value equals present value times 1 plus R raised to the n, right? So if we want the present value equals future value divided by 1 plus R raised to the n. Right? So how do we do that on Excel? So we say, all right, so this is our PV line. We hit the equal sign, and then we start picking out cells. So we'll start with the parentheses equals, what is it? This cell, this cell divided by, parentheses, 1 plus our interest rate R, close parentheses, and then we want it raised to, so this is our future value divided by 1 plus R raised to the n. And the raised to is the shift 6 button, you know, the little little hat thing above the 6 raised to the time period, the 0, the 1, the 2, the 3. Then we hit return. Oh my god. Yes, I want to. I put an extra parenthesis here. And I get negative 100. And as you're looking through this, you can hit F2. It will highlight the cells that cell is referencing. Has anyone done this before? A little bit? A couple times? You done this before? A little bit? Okay. Let me do that again. So I'm going to delete what's there. I want to show you one other little trick. So equals our future value, or no, our present value, divided by, parentheses, 1 plus this, the discount rate. And when I have the cell, or the box thinger over that cell, I'm going to hit F4. And that's going to put those little dollar signs in the G9. What that means is if I expand this formula and move it over to the next column, it's always going to reference that particular cell. This will become clear in a moment. Oh, wait. Okay, so I pressed return and I forgot to add something in. So I can hit F2. I can also click up here and I can add in my raise to the B4 or G4. Okay. Now, what I can do is I can just type this formula one time and I can just pull it over. See this little corner? I can grab this little corner, move the cursor over this little corner, click on the mouse, and pull it over. And it's going to move those cells, move that thing that I put in down 1, 2, 3 times. And all the cells that I referenced in the first formula, I referenced this cell, and this cell. When I move it down, it's going to reference this cell, and remember I put the $sign F4 thing? It's going to hold that cell. So those are my present values. Now I want to add all those up for net present value. Does anyone know how I might do this? Do some sort of formula. Equals. Sum, yes. I want to equal the sum. And then I open parenthesis to say that I want a range of cells. And I move the buttons, I use the arrows, and I hold the shift key down. And then I hit return, and it added all those together to give me an NPV of 18.78. IRR, I'm going to do an equals IRR, because Excel already knows how to calculate that. All I need to do is tell Excel I want the IRR, and then I tell it the range of values. So I'm moving the pointers here, the little arrows, and then when I get to the one I want to start, I press the shift key to select them all. And when I get to the end, I just hit return. Oh, you see what happened? I did these ones. I did the ones that were already discounted for the present value. That's why it came out differently. So let me do that again. Equals IRR, open parentheses, and I want this row. It's going to give me 18%. questions on that? Feel like you might be able to go home and do that by yourselves? Yeah, possibly. So you'll have this, and you can look through this, and any of these orange cells, you can click F2, and you can see what I did. Oh, here, that was just a sum. That was just a sum of these. Hit escape when you're trying to get off. So IRR here. Hit F2. Say, oh, that's just a sum, or that's equals IRR this row. And for these present value calculations, I can hit F2, and you can see up in the little formula box the equals, so this cell equals B5, which is B5, negative 100, divided by 1 plus B9, hard-coded with the $, raised to the B4, which is the 0. And same thing for all of these. This divided by this, raised to this. Okay. So same thing with S. Quick Excel. Any questions on that before we move on? We'll take another look at Excel when we add the modified IRR. I want to make a few comments on this IRR NPV, specifically look at how cost of capital is used in one and not in the other, how that might make a difference. Now, remember, I said that if we change the discount rate, the NPV would change. It's dependent on that cost of capital. And if we increase it higher, the NPV is going to get lower. This is a profile of the two projects. We've got project L in this column, project S in this column. This is the discount rate. We were using a 10% discount rate. So for project L, we got an NPV of 18.9, we'll call it 19. Project S, we got an NPV of 19.95, we'll call it 20. Suppose we were to raise the discount rate to 15%. The NPVs for both projects go down. L goes down to 7, S goes down to 12. That makes sense, right? Higher NPV, or higher discount rate, lower NPV. Then if we raise it to 20, the NPV for L goes negative, and we say, no, we don't want that project. The NPV for S goes down a little bit to 5. Now notice, from 10 to 20 to 15, it went down as we would expect, but we still prefer S in all three cases. We still like S because it has a higher NPV than L. Now, suppose we were to decrease the discount rate to 5%. Decreasing the discount rate is going to increase the value, right? We would expect that, and that's what happens. For 5, the NPV for S goes up to 29, L goes up to 33. If we go all the way down to a 0 discount rate, NPV for S goes to 40, L goes to 50. But notice what happened. The NPV for L is greater than the NPV for S. So the preference switched because of the discount rate change. So 10 and above, we prefer S. Below 10, we prefer L. L now looks like the better project. Why is that? What might have happened? Why is the discount rate change making our decision completely opposite, completely different? Remember the project, for project L, the cash flows came later. And for project S, the cash flows were sooner. So given that piece of information, now tell me, why is our preference changing when we get a lower discount rate? What's happening is these cash flows that are coming later, when we have a high discount rate, they're heavily penalized by that time value of money. That big weight that's coming in year 3, that higher discount rate has more time to eat away at that value. So the cash flows being later are more heavily penalized by a higher discount rate. Does that make sense? Jane? Sort of? Make sense? It's churning? Alright, so we'll chew on that for a minute. The other point I want to make is now we have a different decision. Depending on how we look at the discount rate, our decision is different. Look at a graphical illustration of this. This graph indicates the net present values for L and S. On the y-axis, the vertical axis is the net present value. On the horizontal axis is the discount rate used. This red line is L. As the discount rate gets higher and higher, the net present value of L gets lower and lower. The blue line is the net present value of S. As the discount rate gets higher and higher, the net present value goes lower and lower. Of course, that's what we would expect. What happened that was a little interesting for us is that there was a change in which one was better, in particular above 10%. So 10% or higher, increase the discount rate, the net present value gets lower and lower for S. It also gets lower and lower for L. But below this point, we have a change in preference. So there's no real hard and fast way we interpret this. We just need to keep that in mind. And we need to know that, well, one, we do our best to choose the appropriate discount rate, but we may not get it right. So we need to understand that, well, if we're in an environment where interest rates are really low, where risk is really low, then we need to seriously think about L being our project of preference. But if we're in an environment where risk is high, interest rates are high, nobody's lending, nobody's investing, then we really need to think about S as our project of preference. You might say to your boss, hey, look, boss, I know that interest or discount rate is right here. So yeah, S is looking better. But let's think about what might happen if cash loosens up, people start investing. Let's keep in mind that L is not something that should be overlooked. That's one takeaway from this whole phenomenon of the changing preferences, is that we need to be aware and we need to keep it in mind and realize that that's something we might need to explain. That's one takeaway. And then the second takeaway is what we talked about in a minute ago, that the reason the lower discount rate causes a change is because for S, the cash flows come sooner, and for L, the cash flows come later. That's the reason why there's the difference. Questions on that? All right. This is just about the difference in preferences. So not only might we have a difference in change in preference, note that we might have a conflict between IRR and NPV. So remember, the IRR for L was 18.1. The IRR for S was 23.6. Based on that, we like S. We're like, S, yes, that's the project we want to invest in. And this does not change based on our cost of capital. This stays the same. The preference changes depending on where, for NPV, depending on where we choose or where we put our discount rate. So S has a higher IRR, but if we choose a discount rate of 5%, then L has a higher NPV. So NPV is telling us choose project L. IRR is telling us choose project S. So what do we do in that situation? You have an idea? I'll give you a hint. There's no real right answer. You could just make up something funny you might tell your boss. Give you credit for that. We live in a dangerous financial environment. We're getting conflicting information. So we need to really think carefully about where we are in this lending situation. And we need to keep in mind that both projects could look good depending on how we look at things. Okay. So the reason we have this cross, the timing differences, project with faster payback provides more cash flow early years for reinvestment. If R is high, early cash flow is especially good. So the higher R is, the more we will like those early cash flows. Okay, so that is NPV and IRR. Now I'm going to talk about one commonly used modification to IRR, and we'll call that, wait for it, modified IRR. Modified IRR adds something to the value of the cash flows that we receive early in the project's life. So our example of investing in project L, pay $100, get $10 year one, $60 year two, $80 year three. IRR tells us the discount rate. We would have to discount all those back to year zero. IRR doesn't include something. It assumes that this $10 that you're bringing back to present value at time zero just sits there for the next 2 years. And what math analysts said was, hey, you're missing out on part of the logic here. We could take that $10 and we could reinvest it over year 2 and over year 3. Same thing with this $60 we get in year 2. When we calculate IRR, it just brings it back to present value terms and assumes it sits there for an entire year. We could reinvest it at our company discount rate for a year. So modified IRR adds a nuance for that time value of money. Does that make sense? And the way we calculate it, all right, MIR assumes cash flows are reinvested at the weighted average cost of capital. Modified IRR is the discount rate that causes the present value of the project's terminal value to equal the present value of costs. This will be easier when we look at an example. Terminal value is found by compounding inflows at WACC. So let's just look at the example. So same project, $100 investment for L. At the beginning, we get $10, $60, $80. What we'll do when we're calculating the modified IRR is we'll bring these interim cash flows forward in time to the terminal year. And we'll add those up, the value in year 3. So essentially, we'll find a future value for year 1, a future value for year 2. So year 3, we get $80 to finish up this project. That's already in year 3 value. Year 2, we get $60. We start by bringing that forward. We're going to have a whole year where that $60 can be earning us money. So we compound it, find the future value. The $10 we get in year 1, we're going to have a whole 2 years where that could be earning money. So we compound that forward, and we conclude that in year 3, the terminal value of all our inflows is $158.10. And we compare that to our present value of outflows, which is $100 it costs us to invest initially. And then we find the discount rate that makes those two equal. And we did this way back in class 1. We said, if I invest $100 now, and in 3 years from now I'm going to have $158, what is the interest rate I'm earning? Do you remember that calculation? And that's what modified RR does. It says we invest $100 now. 3 years from now, we're going to have $158. What is the interest rate? You want to calculate that real quick? You all have had to hear me lecture for a minute. Why don't you calculate that, and I will pull up Excel. And we'll think about how we could do this if we had to do it on Excel. I'll put up the screen real quick. So, how do we write this? We've got our year 1, we've got a $100 investment. And this is in year 0. In year 3, we've got 158.1. And we want to find the discount rate that would allow our money to grow at that rate. What's the equation we would use? This one? Yes, right? This present value plus future value divided by 1 plus r raised to the n. All right, so what's our present value in this situation? 100. Excellent. Equals, what's our future value? 158.1 divided by 1 plus r. R is our unknown. Raised to the what? 3. Outstanding. All right, does anyone have an answer? So we would do some re-engineering on this. And we would so we have on this side 1 plus r raised to the 3rd times 100 times 100 equals 158.1. And then we divide that by 100. So then we've got 1 plus r raised to the 3rd equals, what's 158.1 divided by 100? 1.581, yes, excellent. 581. And then what do we do here? What's our next step? What's that? We don't actually have to do the ln, do we? I don't think we have to do the ln if we're trying to find the n, the natural log. But we know we're trying to find r.
Just a
Cubed root, right? So we take the cubed root of this, and then which leaves us with 1 plus r equals the cubed root of 1.581. So we take the cubed root of 1.581 and we subtract 1 from it, and we get r by itself equals what do we got? So cubed root of 1.5. Your calculator may do that directly. You may have to take 1.51 raised to the 1/3. Anyone?
0.1649.
What's that?
0.1649.
0.1649. Sounds right to me. Okay, which is 16.49%. All right, any questions on the mathematics of that? It's good to refresh that and have that clear in your head before we do it on Excel. Questions on the math of that? So we determined that the R, the interest rate, to get from 100 to 158, 16.49. And we did it by setting up this equation and solving for R. Solving for R. So let's do that on Excel. So in this bottom example, put in the cash flows, 100, negative 100. Year 1 we get $10, year 2 we get $60, year 3 we get $80. Sorry, I'm not able to see that with the screen now. Now the first thing we need to do for modified IRR is determine these. Determine these present value, or the present value of the outflows and the terminal value of the inflows. So this is what I've done here. So for this first figure, this first year, I've taken $10 and we've compounded it forward 2 years. Done like time value of money calculation. Second year, compounded that forward 1 year. And third year is already at the point of terminal value. So we don't need to compound it forward at all. All we need to do is add those up. And we get 158. Let's see. And to calculate this, 16.15, I'm going to do essentially what we just did underneath the screen. I'm going to do it on Excel. So somebody help me out here. I guess we can cheat a little bit. We can look at what's happened here, and then we can just step through it. Don, yes.
That 0.1649 is right.
What?
No,
It's not right?
1 point.
Oh, I think it
4.1? You're getting something else too?
Yeah, 4.27.
4, okay. Alright. Let's take a look. Okay. So you solved for R here, and you got 4 point something. So let's think about that. But 3 years, so to get from $100 to 158 in 3 years. So that would be, so let's just do the present value of that calculation. So, or the future value. So future value equals 100 times 1 plus, what'd you get down? 0.04. 0427 raised to the third, right? So what do you get when you crank that out? Someone want to do that for us? Hopefully we won't get 158. That will send me into a panic. I think it's going to be a lot less than 158. It's going to be like 120 or something. 113? 0.6? 0.36? Okay. Okay. So we need, yeah. So we're going to need a higher discount rate. Does that make sense, Don? So you must have done something funky in the calculations.
Just put it all in the Excel.
What's that?
I put it all in the Excel.
Oh, the old.
Yeah, I put the number into the Excel, and so it shows me 0.47.
Oh, okay. So you've still got it. You're putting it in Excel, putting for MR. You modified MRI, modified internal rate of return.
Yeah, I will calculate. I will calculate later. Sorry.
Okay, no, that's fine. Good. Glad you asked the question. Give us a chance to refresh. And I don't use that's the thing. I don't really use the modified MIRR on Excel. I just calculate it. I just work it out this way. Because I feel intuitively it allows you to think about it. So using just to try to calculate it out that way. Can someone help me out? I want to find the modified internal rate of return, so I'm going to hit equals. What's the first cell I'm going to reference? Cube root? All right. Well, look at this. We'll hit F2. It's saying I want to take the 158, which is E23, divided by 100, which is the present value, raised to the 1/3 minus 1. And that's just the fancy stuff that we did underneath here, condensed into an Excel form. Does that make sense? And you'll have, like I said, you'll have this on Blackboard. You can look back at it in your leisure time over the week. Any questions on this? Okay. So, moving along, we've got, we calculated present value of outflows, present value of inflows, and we solved for the modified internal rate of return that would make those equal. So that is MRI. Not MRI, MIRR. This is not med school, sorry. So, net present value is the most common. Internal rate of return, second most common. Modified internal rate of return, is also used, in conjunction, of course, with internal rate of return. These next three we're going to use are not as common, but they are tools. It's useful for you to have in your toolkit. And frankly, they are tools you can use to explain to someone who is not as finance savvy as you are. Someone who doesn't know or is not as familiar with this time value of money calculation. You can use these next three to explain and give a fuller picture to that person. First is a profitability index. This is an index of our future cash flows divided by our initial cost. This is the bang for the buck. If we're investing $100 initially, and this one actually, this does use the time value of money calculations, so you may not have to take someone through the time value of money nuances, but you will use those in your calculation. So we had a $100 initial investment. The present value of the three cash flows add up to $118.79. So our 118 over a $100 initial investment is going to give us a profitability index of 1.1879. So we want this number to be high. Higher is going to be higher profit. Now, question for you all. What is our accept or reject threshold? Is it 1? Higher than 1 we accept? Lower than 1 we don't accept? Do you all like that? Could be a trick question, so think carefully. But go ahead and guess anyway. Well, 1, what would a profitability index of 1 greater than 1 mean? It would mean that this number, present value of future cash flows, is higher than the initial cost, right? So that's good. Now, is it good enough, given our time value of money standards? All right, the answer is, I told you this could be a trick question, so I might have scared you off, but the answer is yes, it is good enough. The reason it's good enough is because this top line is in present value. This top line has already accounted for the return that our debt holders are going to demand. It's already accounted for the return that our equity holders are going to expect. We've already decreased this top number to account for our cost of capital. Therefore, any profitability index greater than 1 is a go, at least in terms of this metric. You may have 5 or 6 metrics. You'll say to your boss, all right, profitability index says go. Net present value says go. Internal rate of return. All right, there's some questions there we need to be concerned about. So this is profitability index. Profitability index greater than 1 is a thumbs up. Payback period. What might payback period be? Anyone want to guess?
1 year, 2 years, 3 years?
Yeah, that's the metric. But how do we calculate it? The answer could be 1 year, 2 year, 3 years. How do we calculate the payback period? So it costs us $100 to invest initially. How long does it take us to get our $100 back? It may have seemed like a trick question, because being savvy finance students that we are, that may sound like a pretty crude, primitive metric to us. Are you serious? You're just going to tell me how long it takes you to get your money back? You're not going to do any present value calculations? But that is something you could use to explain. It's something you can use to put this project in context. Number of years required to recover a project's costs. How long does it take to get our money back? There is one little mathematical nuance you need to be careful of when you're calculating the payback period. So for project L, cash flows are on the top line. Costs us $100 initially. We get $10 year 1, $68 year 2, $80 year 3. So cumulatively, after year 1, we get the $10. We're still out $90. After year 2, we get $60. We're still out $30. Between year 2 and year 3, we get $80. So sometime between year 2 and year 3, we get our money back. Question is when between year 2 and year 3? To find the answer, we say, look, we're getting $80 over the period of 1 year. We want to know at what point we get 30. So we use a fraction. $30 divided by $80 is going to tell us the fraction of year 2. We need to, fraction of year 3 we need to add to the first 2 years. And it just turns out that fraction is 0.375. The answer is 2.375 is the payback period. So this is a crude, rough, contextual way of describing something about this project when we get our money back. Now, what is the big problem we might have as savvy finance students with this metric? It's the main concern we have. Or any concern you have. Any concerns you all have after hearing this way of making capital budgeting decisions. Like I said, it's just a crude measure. It doesn't account for something very important. It starts with time and ends with value of money. No, not the payback's too slow. Well, we use that as a metric for an individual project. And you might say, yes, the payback's too slow. That could be the problem. You could say to your boss, look, hey, I'm sorry the payback's too slow. But the problem we, as intellectual finance students, might have with using this metric to begin with is that it doesn't account for the time value of money. It doesn't discount these cash flows. This $10, the $60, it doesn't sort of account for the fact that the $60 is being eroded in value over the next 2.375 years. That's one big problem for it. Doesn't include time value of money. 2, what about the extra $50 we have left over at the end of year 3? What if we have money coming in year 4 and year 5 and year 6? It just ignores that, right? So, main problem with payback period, it doesn't account for time value of money. Another problem with payback period, it ignores cash flows after. But it does, as a strength, provide an indication of risk and liquidity. Easy to calculate, easy to understand. Ignores time value of money, ignores cash flows occurring after payback period. Make sense? Okay. We can take this payback period a step further and work time value of money calculations into it. We can actually do that. And there is a method of evaluating cash flows that does it. It's called the discounted payback. It uses discounted cash flows. So same project. I believe this is project L, right? We've got cash, costs us $100, $10 in year 1, $60 in year 2, $80 in year 3. First thing we want to do is put those all in present value terms, back to year 1. Put those in present value terms, and then we do our payback calculation. So it costs us $100 in today's terms. A year later, we're going to get $10. But a year from now, that $10, well, in terms of today's terms, that money right now is only worth $9.09. So we subtract that off the $100 that we're out. Difference between $100 and that is $90. We're still at $90.91. In year 2, we get $60 in cash, but since we're smart finance students, we're going to discount that. We're going to say that $60 in cash is only worth $49.59 today. And we are still out $90.91. Subtract it off, that leaves us out $41. Year 3, we're going to get $80, but that $80 is only worth $60.11 because we're putting it in today's terms. So somewhere between year 2 and year 3, we're going to get all of our money back even after we discount the value for it. Question is where between year 2 and year 3? So how are we going to do this calculation? So we know the discounted payback period is going to be 2 point something. Can someone walk me through how we want to do this? It's okay if you want to just look at the slides and explain it to me. I would definitely accept that. Tell me how we're going to figure out between year 2 and year 3. Go ahead and look at the slide, whatever you need to do. All right, how about this? I'll take a shot at explaining it, and then maybe someone else can re-explain it to me. Good for the learning process? So, we're out $41, but we're going to get $60.11. Question is, when will we get our 41 over that time period? So we take 41.32 divided by $60.11. This part tells us the fraction of the year 3 that we're still going to be out. And that ends up being 7/10. If you take 41.32 divided by 60.11, you get 7/10 plus the whole first 2 years we waited. It's going to take us, the discounted payback period is 2.7. Make sense? All right. I guess I'll let go on my threat to make someone else explain it back to me. I think you got the idea. Last thing we want to take a look at is unequal lives. Suppose we have one project that lasts 4 years, another project that lasts 2 years. It's an apples to oranges comparison. Let's put them on the same playing field. Projects T, suppose, lasts 2 years. Project F, suppose, lasts 4 years. And they're mutually exclusive. What does mutually exclusive mean? What's that, Jane? Cash flow affect each other. So if we choose Project F, that is going to mess up our deal with Project T. So essentially we have to choose one of them. And we could do some complicated calculation about what happens to the other one, but for now we'll just say it means we have to choose one. We can't have them both. They're mutually exclusive. These are the cash flows for year T. Costs us $100. Year later we get back 60. Year later we get back 60. A year later after that we get back 60. For Project F, 4 years, costs us $100 initially. We get $33.50, $33.50, $33.50 4 times. We could do a net present value calculation for both of those. And let's do it. Project T, 2 years. Project F, 4 years. Both have an initial cash flow of $100. Year 1, for Project T, we get 60. We get that 2 times. The net present value is 4.132. For year F, or Project F, excuse me, costs us $100. We get $33.50 4 times. and the discount rate we're using for both of them is 10. The net present value is 6.19. So which one has a higher net present value? What's that? F. Yes. F has a net present value of 6. T has a net present value of 4. So which one do we choose? F. F is a good choice, a good guess. But remember that whole deal with T lasting 2 years, F lasting 4 years? What might we do? Suppose T could be repeated. We could do T twice. And over the course of 4 years, maybe that might bring in more net present value than Project F. Project T looks pretty good, right? We get $60 rather than $30. I just wish it could go on forever, right? So, let's do that calculation. What if we repeated T? Suppose that was an option. Replacement chain. No. T could be repeated after 2 years to generate additional profits. Use a replacement chain. Put on a common life. So, year 0, time now, year 1, 2, 3, 4. Project T, we invest 100, we get back 60, we get back 60 in year 2. Year 2, we need to invest another 100, but in year 3 and year 4, we get back 60. Now, the NPV for Project T goes up to 7.5. And the repeated Project T gives us an NPV of 7.5, which is greater than the Project F, which gives us a 6.19. Now that we compare them both on a 4-year to 4-year basis. Any questions? All right, so what have we talked about so far tonight? What are the different methods for calculating whether or not we should accept or reject a capital project? Someone tell me? Net present value is one, and that is the most common, and that's one we've been doing all quarter. Now we just took the extra step of adding everything together and calling it net. What's the other common? IRR is very common, and there's a modification we will sometimes use. Actually, can someone remind us the definition of IRR? Internal rate of return. How do we calculate it? Besides putting it in Excel? What's the intuition? I can tell you're thinking math numbers. Just tell me the intuition for IRR. It finds the discount rate that would what? That would make the net present value 0. Okay, so IRR, net present value, IRR, and then there's one modification that a smart finance person will make to IRR, and they will call it modified IRR. What does it account for that regular IRR does not account for? Remember we said IRR just assumes that money generated in the early life of a project just sits there. Modified IRR says, hey, if you're getting that money back in year 1 and year 2, you can reinvest it. And there's more value there. And you'll notice actually that the modified IRR, an example, was lower, but that was just because it was penalizing. It was saying, well, there's just more money that you need to think about investing, and we need to account for that. So it's going to be a little lower, but it's going to account for the fact that you could invest that money. You need to be investing that money. You need to consider that when you're evaluating this project. So, net present value, IRR, modified IRR. And there's a couple other cruder, quicker calculations we did. What were they? What were the other things we used? Profitability index. Yes. And when, okay, so profitability index is what? What's the number in the denominator and numerator? Close.
Present value of future cash flow.
Present value of future cash flow is in the numerator. And what's in the denominator? The top number is present value of future value, present value of future cash flows. Bottom number is what? Initial cost. And if that number is greater than 1, it's good. We accept it. Absolutely. All right, what are the other two metrics we used, methods we used? Payback period. All right, what is the payback period? Number of years required to recover the investment. So it's good information. You go to your boss and say, this is the payback period. It's 1 year, 2 years. All right, that sounds reasonable. Well, it's 15 years. Oh, that sounds a little scary. So it gives us some information, but there are a couple of disadvantages to using the payback period because it doesn't account for certain things. What are the two big problems with payback period? Ignores time value of money. That's one problem. What's the other problem? Ignores the cash flows after the payback. Yes. So what can we do to correct at least one of those problems? Use the discounted payback period, which discounts the cash flows, puts them in today's present value terms, and then tells us how long it's going to be before we get our money back. So it's going to be 2.3 years before we technically get our money back, the amount of money we invest, but it's going to be longer than that before we get the present value of our money back. So, next time someone asks you to loan them money, you can say, well, what's the MPV of this investment? What's the IRR of this investment? You can say, what's my payback period? Throw them a little curveball by saying, what's the discounted payback period? Like, well, I told you I'm going to get you your money back next week. Well, we got to discount that, put that in present value terms. You're not really giving me my money back in 7 days. It's more like you're giving me my money back in 9 days because it's going to be worth less 7 days from now. Okay, so I think that's pretty much it. We can do what we always do at this point. We can go over questions from the quiz that you took for today. We can go over any of the homework that was due for today or anything looking ahead or any past weeks, anything like that. Questions? Want to look at the quiz? Quizzes y'all took for today? And look at that?
There's no quiz next week.
I think there is. Yeah, there's a quiz, right? Quiz every week. One thing you can count on. Quiz in my class. Were you here when we talked about how you can see the past answers to previous quizzes or answers to previous quizzes? Are you able to see past quizzes? Okay, good. You're on that. You want to look at that? Last week's the quizzes due this week? You want to do that? All right, let's do it. Do you have any other questions or anything? You're good? Okay. Excellent. All right. What's this? Chapter 9 quiz? All right. So, a company's preferred stock currently sells for $92.50, and it pays $8 annual dividend. If the company were to sell a new preferred issue, it would incur a flotation cost of 5% of the issue price. What is the firm's cost of preferred stock? All right, how do we solve this one? Turn this display off. At least I'll be able to see it. Alright, so what's the equation we're going to use to solve this? See you next week, Don. What's the equation we're going to use to solve this?
Dividend over
Yeah, I like that.
price
Yeah.
multiplied by 1 minus quotation.
Yeah, I like it. What do we do? Is it the so preferred stock currently shows is 8% annual dividend. Okay. So remember, preferred stock. A company likes to pay the annual dividend. One thing they dislike doing is messing with that annual dividend because the stockholders will freak out. More so with preferred stock. So if we were to issue a share of preferred stock, we would get $92.50, and we would be very strongly obligated to pay $8 per year. So we're getting $92.50, we're paying $8 per year, so that's something about the cost. But we need to think of one other little kink, and that is that we have a flotation cost of 5%, so we're not getting the full $92.50. So R of preferred stock equals, all right, so let's say that $8 up here into the $92.50, 92.5 times 1 minus 0.05, because we don't get that full amount, we get 95% of it. I think that's going to give us the answer. All right, somebody want to crank that out for us? I like it. 9.10. Okay, so that is the cost of preferred stock. Any questions? You have to go? Yeah, that's fine, of course. Yeah, this is just fine. Do you have more questions, though?
No, that's
Good. All right, good job on the quizzes. All right, Adams Inc. has the following data. 5% is the cost of the risk-free rate. Market risk premium is 6%. The beta of Adams Inc. is 1.05. The question is, what is the firm's cost of common equity from reinvested earnings based on the cap in? I should put this on because this is kind of tricky. So it's the cost of common from reinvested earnings. Now remember, a company can use reinvested earnings for equity projects, and it can also issue more shares. And when it issues more shares, it's more obvious to think about. Of course, they need to do a standard rate of return. But when they use reinvested earnings, there's no cost to that, right? It's just reinvested earnings, cash the company has sitting around. There's no cost of equity for that, right? Yeah, reinvested earnings. It's just like money you have in the bank account. You can just use it. You don't have to pay equity on that. Right. That's not true. Right. So it's money sitting around in your bank account, but it belongs to the owners, and they're going to say we need our standard rate of return on that money. You either give it back to us, or you give us a decent rate of return, or we're going to come to your board meeting. We're going to take away the company jet. We're going to take away the vacations. We're going to fire you all, and we're going to put these 4 Mercy MBAs in charge of your company, and they're going to get it turned around, and they're going to earn me or my return. So you need a return, and how we calculate this out is we have risk-free is the time value of the money. There's also a risk associated with it. In the market, the general risk premium in the market is 6%, and this beta is 1.5. Because the beta is very close to 1, we know that the risk premium for this stock is very close to the risk for the market. So it's going to be a little bit more. It's going to be 5 plus 6 plus 0.5 of 6. And it is risk equals 0.05 plus 1.05. Or 1.05 is the beta times the market risk premium, which is 0.06. It's a little confusing because these are both 0.05. This is the risk-free rate. This is beta. Just so happens they look the same. And that should give us 11.30%. That's the rate of return we must earn. Otherwise, we're out on the street. All right. As a consultant to Basso Inc., we've been provided with the following data. Dividend is 67 cents. The price today is $27.50. The growth rate, 8%. What is the cost of common from reinvested earnings based on the discounted cash flow approach? Okay. So, we're not using the CAPM approach, which we used last time. We're using the discounted cash flow approach. And we know that if we sell a stock, we could sell it for $27.57. Suppose we're a company that pays consistent dividends to common equity holders of 67 cents. We know we're going to have to pay that. In addition to that, our investors are going to expect a growth rate, not only in the dividend, but also in the cost of the share of 8%. So how are we going to do this? We're going to do this like halfway. No, it's an all or nothing. Screen out, screen out. Okay, somebody help me. Say again? Okay, yes. So we're going to set up a numerator and denominator. In the top amount, we want the dividend that we're going to have to pay. The bottom amount is how much we're getting in return for that. And we're going to add a growth figure to it. And the top, Phoenicia, is the dividend, which is 67 cents, times 1 plus growth, right? 1.08. All right. And I can actually put this growth figure here, 0.08. All right, and the bottom is the amount we're getting. Do we need to, it's what, 27? 27.5? So, cost, equity, cost, for stock, 27.5. Now, can we use that 27.5, or do we need to move that forward a year? Yeah, we don't have a flotation, but also that's how much money we're getting right now. I just threw that out as a trick question. We don't need to worry about the price a year from now, because that's incorporated in the growth rate. If we do all that, hopefully we get 10.44. Make sense? Okay. Next question. Assume you are an intern with Rayton Company, and you have collected the following data. The yield on the company's outstanding bonds is 7.75. Tax rate is 40%. Next expected dividend, 65 cents. The dividend expected to grow at a constant rate, 6%. Price of the stock, 15 per share. The flotation cost for selling new shares is 10%. You've got the target capital structure, 45% debt, 55% common equity. What is the firm's WACC? Assuming it must issue new stock to finance its capital budget. Okay, so WACC is weighted average cost of capital. So we need the cost of each type of capital. We need the weight of each type of capital. Now why is so we've got the weights, or do we have the weights? Tell me about the weights. Someone tell me about the weight of debt, weight of equity.
Weight of debt is 45%.
Yes.
And equity is 55%.
Yes, yes. Now why wouldn't we look at, I guess we don't have enough information to even do it, but why do we use the target capital structure as opposed to the market values? Because we've got, I guess we don't have market values. Yeah, we use the target capital structure for no other reason because we don't have any other information, but we use that because that's the way this company operates, way it wants to operate long term, regardless of the fact that market values may fluctuate. So we've got the weights. Good. Now how about the cost of each? What is the cost of debt? We see we've got 7.75%. So can we use, do we plug that right into the cost of debt, or is there something else we need to do with that?
Why did you take out the tax?
Yes, why do we take out the tax? So our cost on outstanding bonds is 7.75%. So that's how much they're paying. Where does tax come into that? It's because something is to tax deductible, right? Interest payments are tax deductible. So the payments we make, we get a little break tax-wise. So our cost of debt is not quite as high as 7.75%. It's a little bit less. So we take 7.75 times 1 minus the tax rate. Now, how about the cost of equity? How are we going to figure out that? Yeah, this is a complicated one here. This is a tough one. A lot of moving parts here. Okay, so to determine the cost of equity, we're going to do the same thing we did over here. Remember, this cost of equity is the dividend plus the growth rate divided by the price plus the growth rate. But there's one other little wrinkle here that was not in the last one. It was the flotation cost, because we're not getting that full price. We have to pay some greedy investment banker 10% of our money. So 1 minus the flotation cost there. All right, do you want me to crank this one out? Should we do it? All right, let's do it. All right, so Alright, so 65 cents a share, so cost S equals plus 1 plus 1 plus 0.06. Stock price is $15 per share. 15 times 1 minus 0.10% flotation costs plus our growth rate 0.06. Okay, so I guess I wrote it out. Why don't you all calculate it for me? Be the note taker. It's a 65. All right, anybody come up with this one so far? 0.111. Anyone else like 0.111? All right, we'll go with 0.111. Weighted average cost of capital. First thing we need is the weight of debt. We know the cost of debt, it said, was 7.75. 0.0775. But that's not the whole story with debt because we get a nice little tax break. We first multiply that by 1 minus tax rate of 0.4. All right, that's the debt half of the weighted average cost of capital. We add to that 0.55 times the cost of our equity, 0.111. All right. Hopefully that should give us the right answer. Somebody want to crank that out for me? All right. There might be an error in the cost of equity. I believe the correct cost of equity is 10.18. So let's move back to this formula here. It's the cost of equity. Dividend a year from now. The next expected dividend. Oh, I see.
Oh, so you want to take the
Exactly.
1 plus 0.06.
Exactly. So it's already done for us. Yes. All right. So let's do. Can we do a quick recalculation on this? So 0.65 divided by 15 times 0.9, and add 6 to that.
1.108.
108. That is the correct answer. So, cost of stock, cost of equity is 10.8%. So let's put this into our WACC formula. 0.108. Now let's crank that out. Okay. Any questions on it? Very good. Next question, I'll start reading it to you as the projector's coming up. Bartlett Company has a target capital structure: 40% debt, 15% preferred, 45% common equity. The after-tax cost of debt is 6%. Cost of preferred is 7.5. Cost of common using reinvested earnings is 12.75. The firm will not be issuing any new stock. You were hired as a consultant to help determine the cost of capital. What is the WACC? This one's pretty straightforward. After-tax cost of debt at 6%. What does that tell us, in terms of what we need to do to it or don't need to do to it? Can we use that number as is, or do we need some tax calculation? As is, yes. Cost of preferred, 7.5. No reason, nothing fancy there. Just use it as is. Cost of common equity, they've already figured it out for us, 12.75. We've got the weights, 40%, 15%, 45%. Right? Just do the weighted cost of all those. Do you want to write it out? Yeah? No? All right. Number 6, the cost of capital used in capital budgeting should reflect the average cost of various sources of long-term funds a firm uses to acquire assets. Sure. The average cost. We've got to pay our debt holders a little bit. Equity holders expect a return. Preferred stockholders need their returns. So the answer to number 6, I'm sorry, but that just came up, is yes. That reflects the average cost. Number 7, the component costs of the capital are market-determined variables in the sense that they are based on investors' required returns. Sure. If our equity investors require 6% return, because of the amount of risk we're taking, because of the type of company we are, then that's how we're going to determine our cost of equity capital. Number 8, the before-tax cost of debt, which is lower than the after-tax cost of debt, is used as a component cost of debt for purposes of developing the firm's WACC. It says that one is false. Why is that false? Before-tax cost of debt, which is lower than the after-tax cost of debt. Which is higher, before cost tax of debt, after cost tax of debt? Now, someone who pays debt, who pays interest, do we like the fact that interest payments are tax deductible? Yeah, we like it. We pay interest. We like that tax effect. So our after-tax cost is going to be lower and better in our eyes. Maybe it's just late, which is lower than the after-tax cost of debt. So that is wrong. The before-tax cost of debt is higher. After-tax cost of debt is lower. That's all they're getting at there. Funds acquired through the firm, through retained earnings, have no cost because there are no dividend or interest payments associated with them, and no flotation costs are required to raise them. But capital raised by selling new stock or bonds does have a cost. That is false. Why is that false?
You do have a cost.
Yeah. And what's the cost? Using retained earnings. Whose money is it? It's the owners, right? You better be earning an acceptable return in the eyes of the owners. Otherwise, they're going to have that meeting we talked about where they're going to be thrown out. You are going to come in and take control of the company. Number 10, if a firm's marginal tax rate is increased, this would, other things held constant, lower the cost of debt used to calculate WACC. If that is true, tax rate increases, then the advantage for paying interest payments and having them be tax deductible is greater. Higher interest rate, higher tax rate, lower the cost of debt. Right. I will be here if you have questions. I'm going to stay a little later. Thank you for coming. It was something of a, I don't know, I feel like you all followed along pretty well. It wasn't an interactive lecture, so hopefully I didn't talk too much at you, but I feel like you all seem to get the concepts pretty well. What's that? Oh, you're having some trouble with your contact lenses? Oh, you forgot them? Oh, okay. Well, if you need me to scroll back to anything you missed because you couldn't see it, let me know.
Question. So the final would be like composing all the quizzes. So you can definitely study directly off the quizzes.
Yes, that is your key method you should use for studying. The final will be very similar to the quizzes. And we'll have a whole class period, I think, class 9, just for review.
Night.
Night to know.